Roll in. Ah,
Sounds good. Sounds good.
good
Okay.
morning, Juan.
Before we go in and say what's going to be with interest rate, I want to explain to you how does the long-term interest rate works, how the mortgage rate works.
Please.
Basically, it's banks' cost of money plus profit plus overhead equals the rate. So most of the times banks have very similar rates one to another, but sometimes some banks are cut their profit and sell the rate a little bit less. It's not sustainable, but they try to build their portfolio. So the interest rate is basically not controlled by Feds. So when the Feds so that's what I want to tell you that a lot of times people say, oh, the interest rate was cut this month. How come the rate, long-term rate went up? So the Feds control short-term rates, such as home equity, car loans, credit cards, but long-term rates controlled by mortgage bond securities. Both mortgage bond securities. Mortgage bond securities are securities that, so basically the loans are sold to Fannie Mae and Freddie Mac and and they bulk it together and they trade them on, open market as a mortgage bond security. So when a mortgage bond security goes up, rate goes down. And vice versa. When a mortgage bond security goes down, rate goes up. Now, sometimes when Feds cut the rates, they travel in the same direction. For example, if the inflation is under control and Fed still want to reduce the inflation and they cut the rate, mortgage bond security hate the inflation. So if it's under control and Fed says, oh, the inflation is under control, the mortgage also, the rates will go down. Also, when a government buy mortgage bond securities, as you know, that when rates were very low in 2021, because government were buying mortgage bond securities. So when the mortgage bond securities went up, the rates went down. The short-term rate cut doesn't mean automatically long-term rates will go down. No, when Fed cuts short-term rates, it affects credit cards, home equity loans, and other short-term loans. Savings, it even affects the savings and CDs because as Fed cut the rate, the savings rate cuts down as well. Okay. Financial. So, what is the projection for next year? So financial markets are moving up and down rapidly as they try to assess how the economic administration will affect the U.S. economy. That affects the economic forecast. So right now, they still projected the rates to be low 6%. However, it's constantly going to be a changing market. Why? Because we don't know what's going to be with tariffs. If they do put the tariffs into China and many other countries, what's going to happen is inflation will go up. Interest rate is the enemy of inflation, so mortgage bond security will go down and rates will go up. If the new administration, their policies will be more favorable, then interest rate will continue going down. The other thing to keep in mind, if the economy will go up, the rate will go up as well. Because when the economy goes up, inflation goes up along with that. So the forecast for next year is basically both Fannie, Freddie, financial institutions. They all think it's still going to be a low 6%, but it's going to be very volatile. So in November, we were close to 7%. We went back down to 6.5%. But the concerns in the new policies will impact the U.S. economy, could affect directly on the mortgage rate. It makes it, if the market expects the administration policy to push inflation, They expect the Federal Reserve to hold interest rates higher and address consumer prices, which in turn affect how 10-year Treasury note fares. The 30-year mortgage rate typically rises and falls in tandem with the yield on a 10-year Treasury note. The strong economy could lead to rising inflation and promote Federal Reserve to pause on the interest rate cut. So I'm going to tell you how a little bit inflation affects the interest rate. So when inflation happens or when in the market there's uncertainty, people move money. Stock market and bond market do not like inflation. So at that time, both stock market and bond market goes down and the rate goes up. However, if in the meeting, Fed would say we're cutting the rate because we believe inflation is under control, stock market and bond market will go up. But sometimes bond market doesn't have a big effect because money moves from safe haven, which is stock market, into regular market, so they move money from bond market to stock market. So, and vice versa, when the economy is really bad, money moves from a stock market into bond market. If money moves to bond market, the rate goes down because the bond goes up. Who buys mortgage bond securities? Mortgage bond securities bought by countries. China is one of the biggest holder of mortgage bond securities.
Do private equities buy mortgage-backed securities as well?
Correct. And
I would imagine they do, yeah.
Buy them, mutual funds sometimes, both together. So multiple entities buy mortgage bond securities. So when a mortgage market is invested in, then a rate goes down. And so how often does a mortgage bond security change? Every day we get an updated rate. So sometimes within a day, if the market moves more than 25 basis points, either way, it goes up or down, we get repriced. If it goes down, we get repriced for the worse. If it goes up, we get repriced for the better. In this year, the market was very unstable. So sometimes we get repriced. We would open up in negative and then we'll get repriced for the worse. And then by 2 o'clock, the market shifts and we got repriced for the better more than once. So it's such a volatile market. And so a lot of times people say, well, I want to wait until rate goes down in order to buy. So we could do analysis to see, like sometimes, especially when they buy not a high loan amount and they want to wait, the difference between a rate is not that huge. So we always tell clients, listen, if you're ready to buy, don't wait for the rate. Because what happened last year? Last year, the market predicted that the rate by end of summer would be 4.5%. What happened last year, end of summer? The rate went up to 8%. So if you're ready to buy, you could marry the house but take the rate. You could always refinance. So let's say, and people will say, well, how much does it cost to refinance? It depends. It depends on the co-op. The refinance cost is $4,500, so it's not that much. And in a house, the refinance, depending if you could do assignment, so you don't have to pay mortgage tax, it could end up costing you $10,000 to $15,000. So my suggestion will be for you guys to tell your clients, let's negotiate $10,000 to $50,000 less on the house, so you could refinance down the line if the rates will go down. A lot of people lost the opportunity to refinance. When the rate dipped to very low 6, high 5, we reached out to a lot of clients and they said, oh, no, we're going to wait until the rate, until we're going to see what happens at the Fed's cut, because the market predicted rates cut to 0.5 point. Well, guess what happened?
Olgita, I'm so sorry to interrupt you. Good morning. What did you say? What do you want us to tell to our clients?
I would tell the clients to continue to buy and just negotiate your price $10,000-$50,000 lower for the cost of refinance. So when rate goes down, you could.
Olga, right now we paying 50,000, 75,000 over the asking, and we're still not getting the properties. How can we tell them that?
Right. Okay. It
The
depends on.
inventory is so fucking low everywhere now.
So what do you think? Do you think if the people will wait until the rate goes down, the prices will not go up? The prices will go up.
No, no question. Yeah, that's the price keeps going up. That's not coming down. It's just that you know, actually I'm here trying to ask you what is the approach for 2025? Where some clients are uh, waiting in the sidelines to see what to do coming in the new year right now because of the holidays and stuff like that. People are stopped going to see homes, you know, but right now coming in new year, they're going to start again. So, but they're asking me every day, they're asking Juan, what's going to happen to 2025, the rates coming down. So, you know, it's hard to tell them what's going to happen.
It is. It is because there's so many variables at play with the new administration, the tariffs. I mean, there's so many elements that can affect that. So everyone's waiting to see, I feel like, don't you think? Is that the feedback the feeling that you're getting from your clients, Juan?
Yeah. They're all just wondering what's coming up and what to do. So, you know, my suggestion, I tell them, listen, buy now because, you know, 5 years ago, people were in the same situation and then they still waiting, you know, a lot of people don't make mistakes. Buy now, you know, and then like Olga's saying, you can refinance later on, you know, it doesn't matter. The rate's a little high right now, but I think 650, it's not bad, you know, that's an average rate.
How far down the line do they wait to refinance? Do they wait a decade? Do they wait 15 years? What's the average time that they wait to refinance?
Usually the refinance market every 5 years. It's always, you know, it hits a low margin and then goes right back. Now, are we in 2025 on the refinance market? Is extremely hard to say. And if people waiting to see, ask them one, if they wait, concentrate on a monthly payment. What do they want to have as a monthly payment? Because a lot of times when you take a look, 0.25% on the rate, it's not more than $100. It's like $50 difference. So half a point is $100, or maybe $150, depending on the loan amount. Even the $250, ask them the motivation to move. And if they're not ready to spend extra 100 to 250, maybe they're not ready to buy it. But if you have given $50,000 to $75,000 above asking price at the rate we are right now, what happens at a rate even if this half a point? You might have to put more than $50,000 higher over asking price. If a rate dips 1%, what's going to happen? A lot of people will get off the sideline, and then you're going to win on the rate, but you're going to lose on the purchase price. So you do the, I used to have a very great Excel sheet where it said, should I wait? And it sounds, I know I shared it when I used to be at a round point, where if you plug it in, what is now at the rate you have now, what if the rate goes down by half a point, but the prices goes up by 10%? Then you're going to be surprised that it's almost break even, and sometimes it's worse to wait for half a point rate reduction if the prices goes up. So it's going to be a very volatile year next year because there's so many uncertainty and so much unknown, and the market doesn't know the policy that the new administration is trying to put it in. We have to see what reaction market will have to those policies. Because remember, if they're going to put a tariff into China or other country, we cannot produce a product at the cost of products that were come from overseas. And if tariffs will put in, that means our product will be more expensive. If it's more expensive, the inflation will go up. When inflation goes up, it's enemy of both. If it's an enemy of the stock market and the bond market. Now, to offset that, what government can do is buy mortgage-backed securities. But if they do that, then you're basically back into break even. You're not really catching up to reduce the rate. Now, historically, we are still a very low interest rate environment. Most likely, we will never be at 3% or 2.75 or 3.5% anymore. So that was a very unusual due to the epidemic. Hopefully, we don't have another epidemic.
Olga, unless we get another COVID-19, you know. Yeah.
Epidemic. Listen.
COVID-25.
Listen, I don't know if, about you guys. I mean, I can only speak for myself. I was thriving during COVID and the quarantine. I don't know about anybody else. Like a lot of people, you know, they have different answers with their individual experience, but I mean, I'm not hoping for another quarantine or COVID. Gosh.
You know what? I discovered a lot of skills that I have. You know, I learned to dance. I learned to write. I learned to do a lot of. I learned to sing. I learned so many crazy things that I didn't know I could do. Yeah, of course.
You see, and you tapped into that. You know, I feel like it was Mother Nature's way of saying, everyone take a timeout.
Right.
Exactly. You know, we learned to cook. No, that's for sure. You know, that's what I discovered in my shrimp recipe. You know, my
oh my God. I love it.
So no, but it's great. I think overall 2025, personally speaking, I think it's going to be amazing. I think great things are coming this new year. So let's not panic. Everything's going to be just fine.
Correct. Because panic, you know, I often say, you know, don't let tomorrow's worry rob today's joy. I say that constantly. It's like on a loop for me. And I didn't take that from anywhere. I made it up myself.
Right. Nice.
If we stay within 6.5% interest rate, we're much better than we were in 24. In most of the 24 average, we were 7 and above. So we still would be a much better position in 25 than we was in 24. Hopefully, the 25 will bring up more transactions where we all could make more money. And I really believe it would. Why? It's because, listen, no matter what interest rate is, people have to move. Some people have to go reduce where they live, so they downsize. Some people have to upsize. Some people get divorced. Some people get married. It's like a food. No matter how much. Now, let me ask you a question. If you go to grocery right now to buy eggs, this week's eggs were now by $1.50. So
they're like $13 a dozen eggs.
Yeah, regular eggs were about $3.50.
$13.
Organic pasture raised eggs, they're both $10. Now, would it stop you buying eggs? No. Am I right? You might not buy so many, but you're still going to purchase. So if you have to purchase,
you just have to change your diet and not eat 2 eggs every day.
Oh no.
I mean, avocados. The other day, I bought 1 avocado. It was $2. They were putting tariffs on Mexico. The price of guac and avocados is going to go up too. Really go up.
Oh my God, that's going to affect me. I love guacamole.
Me too.
That's not good for me.
Yeah, the tariffs are not only China, it's Mexico too. Mexico, Canada, China, like that.
So I think the most important to give our clients a message is, listen, we cannot be afraid. If a monthly payment works, then we could go for it. Now, how do you strategize your monthly payment? A lot of times you could do 10-year interest only. 10-year interest only reduces your monthly payment tremendously. The rate is set. and you pay only interest.
More principal.
Now, a lot of people say, oh, that's very unsafe product. Well, historically, people refinance, they don't keep the mortgage more than 7 years. So, and you're not going to stay in a place, especially first-time buyers, they're not going to stay in a place more than 10, most of them will not stay in a place more than 10 years. Now, we have a great program, even for the co-op, where we could buy, where we could put you in a 10-year interest-only portion of the mortgage. So a lot of times we do that, A, to pass the board because the monthly payment is lower, and B, is for people to pay less, because especially if they buy a one-bedroom, young couple, you know that once they start having kids, they're going to be moving to the 2-bedroom, 3-bedroom, or a house. So it happen more than quicker than 10 years. So that's another way we could do it.
Also, do you recommend us like doing some speculation, or like if the basis points go up 0.25, the monthly payment will be this amount? The monthly 0.25 lower than the current amount, the monthly payment would this be amount? Would you be okay with this buyer to, to get an idea of what they're thinking?
Yep, Rob, I would keep half a point as a buffer. I'm from accounting background. Anything I do, I always do with a buffer. So when I do projection to people, I say, okay, here's the interest rate today, but let's project with a little buffer. I would put 0.25% or 0.5%, and if they're comfortable with a higher amount, then if the rate goes down, they're definitely going to be comfortable. But if you're gonna plan at, let's say, at 6.5, and the rate jump to 7%, they're gonna really be uncomfortable. So you always need to project a little bit with buffer, just to give yourself, because by the time you look for property, find the property, rate would swing either direction. So I always tell people, keep 150 plus or minus, depending on the loan amount. Sometimes if the loan amount is 700, then keep 250 plus or minus. And always can be plus or could be minus. It doesn't have to be a plus. You could see in November, we were at 7%. In middle of December, we were about 6.5%. The swing is 0.5%. So it could swing either direction.
That's good advice to have, I mean, you always want to have a buffer reserve.
Absolutely. And if, let's say, for example, if your debt to income ratio is 49% at 6.5, well, maybe you should look for property lower amount, because you don't have a buffer, you don't have the room.
Yeah, because that's what I was justifying to what Juan was saying. If we are putting an offer $50,000 over, and they get scared because of the rate, well, Mr. Buyer, can you afford this rate at this amount? Because in six months or so, it's going to drop down and you can refinance. So if you're okay with this monthly payment for 6 to 12 months, you just date the rate and then refi later, correct?
Well, here's the problem with that scenario.
Okay.
If you give $50,000 above asking price, you have to make sure that when they do ready to refinance, it will appraise. Because if it doesn't appraise, they cannot refinance unless they put more down.
Understood. Okay.
Okay. So for example, if they buy for 550, if they're listed for 500 and they buy for 550, make sure you have comps for 550. Because if you don't have comps for 550, the refinance will not be possible. So I had a client in August closed at 7.75% when they were buying a co-op. And so I got this deal from Chase. Chase cannot lend on purchase price for co-op. They have to lend based on appraisal. So appraisal came in at 625. The purchase price was 700 on the co-op. We lend based on the purchase price on the co-op only. So we were able to do the deal without people putting more down and paying mortgage insurance. So when the interest rate dipped, I reached out to her and said, I know you bought a year ago. Do you think the property went up in the value? She said, we don't think so, because the next door neighbor sold similar apartment of ours for 650. So that means if I'm ready to refinance from 7.75 and the rate was 5.75 right before the rate went up, she had to put $50,000 more, which she didn't have. So she said, okay, we'll wait until the property goes up in value and rate will continue going down. So if you overpricing the property and both overpriced property, the most important is not the rate, is can appraisal hold 6 months to a year? If it doesn't, now another thing, you cannot refinance.
But what if it's a hot market like Juan's in Suffolk County, right? In Nassau, Suffolk County, if it's a hot market and the homes are being sold a certain amount, and then 6 months later, those comps come out.
If they come out 6 months later, no problem.
Okay.
But if it doesn't come out, then you gotta be honest with the client. Don't promise them to refinance if the property will not be valued the same amount they purchased, because you know what's going to happen? They're going to think that you sold the property over the market price. They have to understand that overbidding the price, and it might take more than 6 months to get there.
Well, my experience right now in the last 6 months, it's well, like let's say 5 years ago in Nassau County, where I live, the production were like every house is going to cost $1 million, right? Right now it's 950. I'm talking about the split houses. So literally the value every day and everywhere. I went to New Jersey this past weekend, and there were 50 people looking at one house that I want to, help my buyer buy. We pay the asking, and there were like maybe 20 asking offers. And today they're sending us an email to put the highest and best. So we are giving another 50,000. That property is going to appraise easily. Like in 6 months, it's going to appraise. If they do, obviously it needs a lot of work. But if they put in a couple of $100,000 in the house, it's gonna be worth $1 million, because that neighborhood is amazing. So
what neighborhood is that?
It's a Fairview, New Jersey. It's a great area there.
New York is booming, absolutely booming. Some of New York areas are booming as well. But like I said, it's great, but prepare your clients just in case. You know what happens when the market goes very high? It's a law of accounting. Anything goes up, goes down. Anything goes down, goes up. So you can't think that every year the market will go up and the speed is going up right now. Just prepare them. They might not, but if you keep promising them, all they're going to remember, yes, I could do it, and the value will be there in 6 months. It probably will, but just, I think just be cautious of promising them.
What are the property taxes like there, Juan? Because I know that in Nassau and Westchester County are the highest, those two.
Yeah, I pay like my taxes. I pay around 15,000 a year, and but you know what?
Fairview's got to be less. I mean, I would imagine
it's Fairview. It's about 8,000. It's not bad. But you know what? The taxes. I always say that this is just because of the lifestyle, the quality of life that you live in the neighborhoods are amazing. The taxes 100%. Are because that's like. I was talking to Maria yesterday about Hicksville, one of the nicest neighborhoods to live. It's amazing. How the people, the school system, the train, railroad is right there, the malls, everything is perfect. And I don't have a problem paying the tax. To be honest with you, my kids went to school. Couple of them went to college. One graduated already. The other one in high school is doing amazing. And so, I mean, why am I going to complain of paying taxes?
Yeah, no, it's a lifestyle. You pay into that directly. I mean, it's like a HOA in a gated community. You're paying that for a reason, to keep up the value and the standard of the house that you're investing in.
Exactly. Yeah.
And taxes covers the better school system. Because if you
100%.
if you take, let's say you have two kids and you have to take private school, it's much cheaper paying higher taxes. Am I right, Juan?
Yeah, absolutely. Yeah, I mean, but again, the private schools between the public schools and I don't know much about private schools because I haven't sent my kids to private school, but I know that the public schools over there in Nassau County
Mm-hmm.
are 10 times better than the public schools
Top
here in
tier.
like
Yeah.
in the
I mean,
border. So
I went to Edgemont in Scarsdale, and public school. I didn't go to private school my whole life, and the schools are like top tier compared to, New York City like schools.
yeah, that's what I'm talking about. Yeah.
Mm-hmm. 100%.
You see, I believe that in any market, whether it's a rate up or down, there's opportunity to ride on the market. So when COVID happened, I think for real estate, it was the best years. It was best year for real estate. It was best years on mortgage. And last 2 years in COVID, it was the best year for all mortgage loan officers because the market was really moving. I mean, the monthly payment was so much lower, it's like 0.5%. Instead of paying 6%, you really paid 3%. But even then, people were on the sideline to buy. They said, oh, I'm going to wait another 0.5 point. And then some of them missed the boat because they waited too long. The most important to ask is, what is your motivation to buy? How motivated are you to move? And if the motivation is high enough, you have to work on their monthly budget. To work on a monthly budget, let's say so I had a client call me, they said, I want to buy a one-family house with a 3-bedroom garage and a detached house. My monthly budget is $3,500. So realistically, she cannot buy nothing in New York City. She had to go into Long Island, in Fibro, New York City. She had to go in Long Island where the tax is higher, but the purchase price is lower. BFA, one of the realtors found something like that, and they went on a contract. But even though the 0.5 point rate differences, it helped her to still buy lower purchase price, a little bit higher in taxes, because in New York, $3,500 would not cut. No matter whether the rate is 6% or 7%. So if you work on the monthly budget, you could know what to show with with $250 plus or minus variances. What do you guys see as far as the real estate in your prediction for 2025?
Olga, I have a question for you in regards to like 2025, in regards to mortgages. I've been seeing a lot of the mortgage takeover because of the rates. Like, is that going to be possible in New York? Like people taking over their mortgage origination?
You mean people, let's say they buy a house, they could take over their mortgage?
Yes.
Okay. It always was possible only on the government loans. Fannie Mae and Freddie Mac will not do it because it doesn't make sense for them. But FHA loans, VA loans, you could take advantage of taking over their mortgage. But here's the disadvantage. You will take over their mortgage, but you must live in the property as a prime resident. So if the people who selling have FHA loans, and if you buy, you have to stay in the property, you could take over the mortgage. But unfortunately, depending where you sell, it's not that many FHA loans, especially in like in certain area, 5 boroughs of New York, it wasn't heavy in FHA. In certain areas it was, but in prime areas it's not. In the Long Island one, see if I'm correct, that's not many people do FHA where you live. Am I right?
Well, it all depends on, I guess, the seller's acceptance of the offer, but It's
It's
it
not,
depends.
Ralph, it's not only seller acceptance of the offer, seller has to have FHA loan to do it. And
Yes.
people who buy it must buy it as a prime resident, but it's an awesome way for you to market the property.
And how about subject to deal? I guess that subject to, because I've been learning about that as well.
What do you mean subject to deal? What do you mean?
Like the seller agrees to buy to for the buyer to buy the property, but they keep the mortgage under their name.
No, I've never seen that, and the banks will not allow that, and title company will not allow that either. Ralph, think about it. If a seller's gonna keep the property under their name, and just a mortgage under their name and give it away.
Yeah, look, it was a friend of mine that is actually in Texas, and so they were saying that they found the property subject to for the seller to actually be in agreement to keep the mortgage under their name, but the buyer will continue to make the monthly payments. Of course, there's some positives and negatives of that, because the negative is that the seller's still under the ropes, and if the buyer doesn't pay, then they'll be inclined to be in foreclosure. So they're going to foreclosure. So that's something that I've read. But
no, but wait. So is there an agreement?
Yeah, an agreement.
Who's gonna hold the title? Seller or a buyer?
I believe it's gonna be the seller that still holds. They just in agreement that they'll be making the monthly payments.
So
Yeah, Ralph. But Ralph, I'm sorry. What marketplace is this? I mean, where is that happening? Because not in New York. In New York, that's
No,
not
in
happening.
Texas. In Texas. In Texas.
But right, even in the taxes, right? If the seller keep holding the mortgage and on the title, and he gets a person to rent the house, that they're really acting as a tenant, not as a buyer.
Correct.
Maybe they have option to buy, so they could rent for 2 years, and some of the rent goes to the purchase price. But if they're not on the title and if they're not on a mortgage, they're tenants. They're not buyers.
Hi. So I actually saw something like that as well in Staten Island. It was an ad on Zillow stating, and my client had sent it over to me because he was interested. It was a building that was being sold. There was 2 people on the title. One person wasn't paying, the other one was, and he just wanted to sell the other half. So they wanted to sell half of it, half of the responsibility, and the other person still wanted to stay on the mortgage and everything, which my buyer wasn't interested in that because he's like, what's the point? I want to purchase the property on my own. But yeah, they were trying to sell it like that as well.
Is that the 1 to 4 family house or the building?
It was a 6 family.
Okay,
in
that's
Staten
a
Island.
commercial. It's very different. On residential, you will not be able to sell half of your property with having another person getting a second mortgage for the other half. It doesn't work that way in residential. Commercial is very different than residential.
So what I was reading here, right? Because I had a friend of mine sent a property over that's in Texas, right? That for 19,000, I guess it probably got earnest money, I guess deposit. It says seller to deal is a real estate transaction where the buyer takes over the seller's existing mortgage payments while the seller remains legally responsible for the loan. The buyer is responsible for making the mortgage payments, but the seller's name remains on the loan. The buyer may be able to get a discounted price, lower interest rate, or little to no money down. The seller receives payment up front and can quickly sell the property. The seller may be able to avoid foreclosure and protect their credit score.
It's basically a rent to buy.
I guess that's the.
It's a rent to buy.
That's the definition. Yeah.
In New York, I have not seen that many in New York, five boroughs or Long Island. It might work in a different state. So how does it work, rent to buy? They go into agreement and they say portion of the procedural monthly rent goes towards the down payment. And then they have to execute when tenant takes over. It's not that in New York, it's not that I have not seen it at all. A lot of I've seen it in Florida, I've seen it maybe in Texas, but it's not. So unless you guys see it, I haven't seen it. And I don't know how it's going to be with financing. Financing will be only when buyer takes over the whole house and the mortgage. They could take over the mortgage if it's FHA under their name with the same rate as long as they live in the property. And if it's not, they have to get their own financing under their name.
Now that you say that, I've seen that before in like Nassau, Suffolk border, some mansions that they rent it first and then it's the rent to option to buy. I never knew that it was also called that as well, subject to deal. So yeah,
It's a rent.
there is some instances there in Long Island that they have that option.
Maybe some pockets. Now, where would that be beneficial? Only in a market where the houses don't sell good. If you have a market where the houses are very hot, this is not going to work, because if you overpaying for the properties above the asking price, why would the seller give you property with a rent option to buy? Property going to sell with a higher purchase price that's offered to him. Am I right, one? It will only work rent.
I'm so sorry, Olga. What was the question? I'm sorry. The system kicked me out.
In this market, in New York, most of the areas where it's hot areas, rent the subject to buy will not be an option because they will sell it with a higher bid to purchase on the hot markets. Am I right?
Yes, correct.
Yeah, you're right.
Yep.
Right? So if the areas are not that popular, maybe it's an option to work it that way. It's another angle. Attorneys put a contract together. Banks don't get involved until the buyer takes over the house and the mortgage.
Understood.
I also want to tell you, loan amount. Loan amounts for Fannie and Freddie increased this year. So every year by end of November, they put down how much is a conforming limit. So you have conforming, you have high balance, and you have a jump. So the conforming limit, give me 1 second, I'm going to tell you for each property.
But Olga, I think, what I see out there, people have money. This is people that have businesses still, construction companies. They work in different businesses, and even people selling, a family, like 2-family house, buying. Like I put an offer in the co-op this weekend, and people paying cash, $300,000 cash. Like there were a few offers over the asking, like 60,000 over the asking cash. Obviously, this one is a sponsor unit, but people have money. Then I ask, why they do that. They say they don't know where to put the cash in the sponsor unit. It's easier to buy. The one I sent you, Olga, yesterday, that's gone already. Like 20 offers in that unit. People have money. We worry about. We're not supposed to be worried about. People come. The buyers come. The buyers somehow. They get co-signers, they get family members to live with them. They because the rents are crazy now. If
So crazy.
it's either you get a mortgage or get the rent, almost the same thing. So
they're just looking to park their money that they have. They're not making moves right now.
And you're right that people have money. A lot of times when they downsizing, when they sell the property, they have a lot of equity. So in the last 4 years, the equity almost doubled. So if they cash out on their equity, they don't have to pay taxes on the, if you have two people living in the house, it's $250,000 tax advantage. So $500,000, they don't have to pay taxes. So they could buy more than one property. A lot of people buy properties for their parents, cash. They take out from the businesses, or they take out from their prime residence, they do home equity, and they buy the property because a lot of co-ops don't allow people to buy for the parents or kids, but when you buy a sponsor unit, it's not an issue. So they will overpay for sponsor units. And another good thing about sponsor units, sponsor usually do full renovation, so they buy fully renovated properties.
What's another way to
Absolutely.
get around somebody that has a lot of liquid assets, like they're cash heavy, but they don't have like their their tax statements in order, as well as, bank statements that are, I mean, how do you get around that? Because there are, a number of people that, have a lot of cash reserve, but they don't have the necessary documentation and the paperwork to get a mortgage, let's say.
Well, there is still a lot of banks will do no-income verification loans. We don't do them, but there's a lot of sexy loans out there. But sometimes whether people have money. But because of uncertainty in the market, people move money from stocks and buy real estate, because real estate is a little bit more safer in their eyes than the stock market, because if the stock market will not do good, then they lose the money. But in real estate, in the long run, it still has at least 5% gain in equity every year. So they just reposition their wealth. So they would buy a sponsor unit or a house and rent it out, or have the parents live there. We have a great program where we could finance purchase for the parents or kids that they don't work. So parents buy for the kids buy for the parents. So in that case, parents don't have to be an owner, or don't have to be on a loan. So if they buy it, we could still do it rate as a prime residence with 20% down or even 5% down. Treat it as if people buy it for themselves. It's an awesome program. I've done many of them, and it works great. But parents need to live there. It's not going to be your investment property. But we do have a lot of kids buying for the parents. In our culture, or people from Orient, they always take care of the oldest. I've seen it so many times where I get a call and listen, I have a house, I make $300,000 a year. My DTI is very low, but most of co-op don't want to take me because I want to buy for my parents. What do I do? So if a co-op doesn't take you, then it's a problem. But if a co-op okay to do it, then we could do it. A house is not an issue. We could do it 100%. Condo, we could do it 100%. But buying for the parents, they want parents to pay or pay for parents, not $5,000 to $6,000. They want to pay $2,000 to $3,000, or maybe even just pay maybe. So it's definitely possible. But I do see a lot of people pulling a lot down. I have a case where I have a client owned a Forest Hill house for $1.8 million, buying another house in Brooklyn because the job moved. So he's gonna sell his house for $1.8 million, buy for $1.2 million in order to take $300,000 mortgage. The rest is gonna put in stock. And I told him, the wife, you could buy it outright without any mortgage. She said, no, I still want a mortgage. It's still, my money don't make more than 6.5% in stocks. So he just gonna do $300,000. But His offer was accepted much faster than any other offer, was 20% down. But we could still, so what Fannie Mae did good is they allowed 5% down on two-family house. And I believe 10% down on three-family house. So you don't have to always go FHA. What's the difference between Fannie and FHA? FHA, unfortunately, you cannot get rid of mortgage insurance. Fannie Mae, when the value goes up, you call the bank, even if you didn't pay down the mortgage, the value organically went up. In a year or so, you call the bank, they'll do another appraisal at your cost, and they will remove the mortgage insurance. As long as value is 78%, you have to be 2% lower than 80%, and they will reduce the insurance. So before you do that way, just make sure that you analyze what is your value of the market of the house. I believe, like, for example, I don't know if you guys remember, there's always going to be changes in the program. As tough times comes in, banks becoming very creative. They come up with 100 different programs to make the deal work. So we have, I think, 5 or 6 different first-time buyer programs. Between Sonia Mom, we have a program where first-time buyer, Fannie Mae first-time buyer, depending where buyer lives, regardless how much money they make, regardless how much money they have, they could still get $10,000 credit towards closing costs and down payment. The rate is about a 40% lower than the market rate. But you have to be first-time buyer. At least one have to be first-time buyer. So if you have a couple buying it, one must be first-time buyer. The second one cannot have the property at the time of purchase. They don't have to be first-time buyer. They can own the property the last 3 years, but they cannot own at the time of purchasing. So we have a client buying a co-op in Manhattan for $1.5 million. They were taking a mortgage about $850,000. They still got $10,000 grant and a lower interest rate of about 6.25% at the time. So it depends where person lives. Now we also have a program where person buys. If the person buys a low to moderate income level area, you also get a lot of grants and the different perks. We also have a program where clients make very little, let's say it's a 50% or median income of the area, then they also could get a grant and a reduction of the rate. If you're not a first-time buyer, but you work for the city, you work for the certain hospitals, we have $1,000 grant that not a lot of grants you have to pay back. So that's a great option that you don't need to pay back. You do not put down the UCC for the grant. So if you work for the city as a teacher or as a police officer or fire person, you know, certain where you work, is definitely get a grant as well. It's just $1,000. Listen, $1,000 is still better in your pocket than in a bank's pocket. So, you also have, you could buy for your, we have a program, say, family purchase. You could buy for your family. Fannie Mae has a great program. You could buy for your parents, and the parents don't have to be on a stock lease or on a deed. We have a family, we have a medical program. So if you have a medical person buying the house, we could go, I believe, 89% financing without mortgage insurance. So that's another great program. So there's a variety of different programs available for the purchaser. So a lot of times people say, what's the difference between this bank versus the other bank? Well, the interest rate could be very similar. There is just a difference of the programs that allow for the bank to, you know, to offer. And when we speak with clients, we find out what the clients need, what their financial goals, what their not only goals for this year, but 5 years down the line. Because if the goal is just to keep the house for 5 years, well, 10 years interest only works. But if the goal is they're not, they might stay there forever, then maybe interest only is not best for them. So we have to analyze each situation differently. And as a previous CFO of multi-million-dollar company, it's easy for me to listen, strategize, and guide them to exactly their financial plan, not what we think is best for them, what they think is best for them. Let me tell you the new loan. So we had 766,550 maximum loan amount for one family. Now it will go up to 806,500. For two families, the limit will go to 1,032,650. For three families, the limit will go to 1,248,150. And for four families, 1,551,250. That's on a conforming limit. On a high balance, the limit will be 1,209,750 for one family, 1,548,975 for two families. For three families, 1,872,225. For four families, 2,326,875. Now, why would people will want to do conforming versus jumbo? Well, jumbo loans are more stricter than underwriting. Conforming loans are much more flexible because Fannie Mae, you go through desktop underwriting, and Fannie Mae will give you exactly what parameters are. And you can go up to 49% in some cases for debt income ratio. You do not require a big reserves unless you buy a two-family house, you require 6 months reserve. But in general, if you buy a one-family house on a Fannie Mae deal, we do not require reserves. On a Fannie Mae deal, credit history and the credit score and the credit trade lines are much more flexible than on a portfolio loan. In portfolio loans, most of the banks wants to see at least 3 trade lines for the last 2 years. So it gives, when a Fannie and Freddie increases the limits, it gives a little bit more flexibility. And rates usually cheaper on conforming versus high balance. If we see on a high balance rate is higher than a portfolio, we switch to portfolio as long as the client qualifies for portfolio. For portfolio loans, most of the banks requires reserves, sometimes 9 months to 24 months reserve. So before we place a certain program, we have to really analyze each individual financial situation to see which program will fit them best. But increasing the loan amount of performing and high balance is a huge help, especially when the market, the prices goes up, it gives opportunity to the buyers to be in a much more flexible underwriting and better rate. You guys have any questions, any concerns? Did I bore you to death?
No, I think I thought you did a great job, Olga, as usual. Thank you so much for the great information.
Thank you.
We glad, we blessed to have you around. You know, we always have questions. You're always willing to help, you know, doing this for us, for the team. Thank you. That's all I can say. You know, we blessed to have you around.
Thank you, guys. I'm glad to be around you guys. I've been around for 20 years with you. I started in November of 2004. I was introduced to Vincent O'Reilly in the end of November, and our relationship is 20 years, 20 years today.